Okay, so you want to own a nuclear power plant. Here's the pitch you've been telling yourself. An asset that runs 24 hours a day, 7 days a week, generating electricity whether it's cloudy or calm, whether it's 2 in the morning in January or peak summer demand in August. It doesn't burn fuel the way gas plants do. The fuel costs are tiny compared to the output. Once you've built the thing, the electricity essentially flows forever. Clean, reliable, unstoppable. That is not wrong. It is also not the full story. Here's the real picture. A nuclear power plant is one of the most financially lethal capital projects ever invented. The upfront cost is so large it dwarfs almost any other infrastructure investment. The pre-revenue timeline is measured in years, sometimes decades, and buried in every nuclear plant's financial structure is a liability that never disappears. Not during operation, not during retirement, not for generations after the plant has closed. The money the plant generates is real. The costs that will consume that money, from before the first kilowatt hour to decades after the last, are real too. Understanding the gap between those two things is the point of this video. Before the numbers, let's reframe what you're actually buying. Because a nuclear power plant is not a power generation business. It is a time machine with a bill. Here's what that means. When you commission a nuclear plant, you are making a financial commitment that runs in multiple directions across decades. You are paying today for electricity you won't sell for 10 to 15 years. You are selling electricity today, while accruing costs you won't pay for 30 or 40 years. The decommissioning obligation, the cost to safely dismantle and clean up the plant after it closes, is a liability that exists from the first day of operation and doesn't get paid until the last day and beyond. The plant's financial structure stretches across so much time that the people who make the decision to build it will often be dead before the last bill arrives. That reframe is the thesis. A nuclear plant's economics don't live in the present tense. They live in the future tense, and in an industry where cost estimates have historically been off by a factor of 2 or 3. The future is a very expensive place to make assumptions. Let's start with what it costs to get through the front door. There is no other asset class in this series where the entry cost is so vast and so reliably misestimated. The U.S. Energy Information Administration, using 2023 values, puts the overnight capital cost, meaning the construction cost if you could build the entire plant instantly, with no financing, at approximately $7,800 per kilowatt of generating capacity for a new large light water reactor. A standard 2-unit plant generating 2,200 megawatts of capacity would, on that estimate, cost approximately $17 billion to build before financing. But overnight capital costs are theoretical. Real nuclear projects are not built overnight. They take 10 to 15 years to complete in the United States. During those years, the capital you've committed is sitting idle, accruing interest, not generating a single dollar of revenue. When financing costs are included, the real cost escalates dramatically. The most recent completed nuclear construction project in the United States, Vogtle Units 3 and 4 in Georgia, originally budgeted at around $14 billion, came in at more than $35 billion. Construction began in 2009. Unit 4, the second reactor, began commercial operation in 2024. 15 years of construction, $21 billion in cost overruns. For context on scale, Vogtle Units 3 and 4 produce approximately 2,200 megawatts. At the final cost of roughly $35 billion, that works out to about $15,900 per kilowatt, more than double the EIA's reference estimate, and roughly 10 times what China and South Korea typically spend building equivalent capacity. The Congressional Budget Office, analyzing the 75 nuclear units built in the United States between the mid-1960s and late 1970s, found that the average cost overrun was 207%. In other words, the actual average cost of those plants was about triple their estimated costs. That pattern has not been corrected. It has been repeated. If you're considering an existing plant rather than new construction, purchasing a currently operating reactor, valuations depend heavily on the remaining license term, the decommissioning fund balance, and fuel inventory. Operating plants in competitive wholesale markets have sold for as little as $1 per plant when operators couldn't make the economics work, a phenomenon we'll come back to. Plants in regulated rate-based markets, where costs can be passed to customers, are valued very differently. Here's what happens before a single watt of electricity is sold. The Nuclear Regulatory Commission, the NRC, is the federal body that must license any nuclear facility in the United States, and its review process is not fast. A combined construction and operating license application, submitted to the NRC, can take 3 to 5 years just to reach approval, assuming no significant public challenges or regulatory revisions arise during the process. If they do, and they often do, the timeline extends further. No revenue, no electricity, no return on capital, just carrying costs on an empty site. Then there are state and local permits, environmental impact assessments, water use agreements, site suitability determinations, transmission interconnection agreements. The total pre-construction regulatory process for a large nuclear plant in a contested market can consume 5 to 8 years and $500 million to $1 billion in development costs before a shovel touches the ground. The American Action Forum calculated that the average operating nuclear plant in the United States bears an annual regulatory burden of approximately $60 million. That figure covers roughly $8.6 million in direct regulatory compliance costs, $22 million in fees paid directly to the NRC, and about $32.7 million in regulatory capital expenditures and liabilities. This is not a startup cost. This is every year, ongoing, for as long as the plant operates. Insurance is another category where nuclear is structurally unique. The Price-Anderson Nuclear Industries Indemnity Act of 1957 requires operators of commercial nuclear plants to carry the maximum amount of private insurance available, currently around $500 million per reactor, and participate in a pooled secondary layer that can reach several billion dollars in the event of a major accident. This insurance pool cost is shared across the industry, but the annual premium for a single unit plant runs in the tens of millions of dollars. It is mandatory, it cannot be negotiated, and before operations begin, the plant must demonstrate financial assurance for decommissioning. Federal regulations require operators to have a credible plan and funded reserve to dismantle and clean up the site at end of life. The NRC's minimum formula estimate for a single reactor's decommissioning runs from $280 million to $612 million. Site-specific estimates, which tend to be more accurate, often put real decommissioning costs between $500 million and $2 billion per unit. This reserve begins accruing on day one. It is a liability that exists before the plant has generated its first dollar of revenue. Now let's talk about the money the plant actually makes. Revenue for a nuclear plant flows from 4 distinct channels, and they work quite differently from each other. The first and dominant stream is wholesale electricity sales. Nuclear plants sell electricity into the grid at the prevailing market price for their region. A 1,000 megawatt plant operating at a 90% capacity factor, which is typical, nuclear plants run almost constantly, generates approximately 7.9 billion kilowatt hours per year. At a wholesale price of $40 per megawatt hour, which is a reasonable representative figure for many U.S. markets, that's roughly $316 million in annual gross electricity revenue. At $60 per megawatt hour, more typical in tight markets or peak price environments, it's $474 million. The electricity price is the single most important external variable in a nuclear plant's financial life, and it is the one the operator controls least. The second stream is capacity market payments. In organized wholesale electricity markets like PJM, which covers the Mid-Atlantic and Midwest, generators receive payments not just for the electricity they produce, but for being available to produce when needed. This capacity payment is a separate revenue stream, paid annually, and for a reliable baseload plant like a nuclear reactor, it can add $20 million to $50 million or more per year, depending on market conditions and the cleared capacity price. The third stream is clean energy credits. The Inflation Reduction Act of 2022 created the Section 45U Zero-Emission Nuclear Power Production Credit, which pays existing nuclear plants up to $15 per megawatt hour for electricity produced and sold through 2032, subject to a phase-down mechanism tied to market revenues. For a 1,000 megawatt plant producing 7.9 billion kilowatt hours annually, this credit can represent up to $118 million in annual federal tax credits, a meaningful supplement that has, in several markets, been the difference between a plant staying open and being forced into early retirement. The fourth stream is increasingly relevant: power purchase agreements with large commercial buyers. The explosion of AI data centers and corporate clean energy demand has created a new market for nuclear power. In 2023, Microsoft agreed to purchase electricity from a plant being restarted in Pennsylvania at a price reportedly above $100 per megawatt hour. In 2024, Amazon, Google, and others announced deals to purchase nuclear power at premium prices to meet corporate sustainability targets. These long-term, fixed-price agreements fundamentally change the risk profile of a nuclear plant. They provide revenue certainty over a decade or more, shielding the operator from the volatility of spot electricity markets. They are also available to only a small number of plants in the right geography and regulatory environment. Now let's talk about what it costs to keep the lights on. Existing nuclear plants in the United States have spent the past decade relentlessly cutting operating costs, and by most measures they've done it. The Nuclear Energy Institute, which tracks industry-wide generating costs, reported average total generating costs for operating U.S. plants in 2024 at approximately $33 to $34 per megawatt hour for both boiling water and pressurized water reactor types. That figure covers fuel, operations and maintenance, and capital expenditures, but notably does not include property taxes, debt service, depreciation, or decommissioning fund contributions, the costs that make or break the business. Breaking it down, fuel costs at a nuclear plant are remarkably stable because uranium prices, while volatile, represent only about 25% to 35% of total operating cost. A 1,000 megawatt plant consumes roughly $70 million to $90 million in uranium fuel per year. Operations and maintenance, the roughly 500 to 800 full-time employees required to run a nuclear plant safely, plus the systems, spare parts, and ongoing regulatory compliance programs, run approximately $150 million to $200 million per year. Capital expenditures for equipment replacement, safety upgrades, and license extension work add another $50 million to $150 million annually. Then there's the decommissioning fund contribution. Federal regulations require operators to make regular deposits into a segregated trust fund sufficient to cover eventual decommissioning costs. Depending on the current fund balance, expected future decommissioning costs, and assumed investment returns, annual contributions run roughly $10 million to $30 million per plant. This money is locked away. You cannot touch it. It cannot be used for operations. It accrues over the plant's lifetime and is released only when the NRC certifies that decommissioning is complete, a process that itself takes decades. Property taxes are the final large operating expense that rarely gets mentioned in discussions of nuclear economics. Nuclear plants are among the largest pieces of taxable property in their communities. Annual property tax bills at major nuclear facilities commonly run $20 million to $50 million per year, constituting a significant fixed expense that doesn't decrease when electricity prices fall. Added up for a 1,000 megawatt plant, fuel $80 million, operations and maintenance $175 million, capital expenditures $100 million, property taxes $30 million, regulatory costs $60 million, decommissioning fund $20 million. You're at roughly $465 million per year before touching debt service, insurance premiums, or corporate overhead. Against gross electricity revenue of $316 million to $474 million, you can see immediately how thin the margin is and how sensitive it is to the electricity price. Here is the structural risk that most people who think about nuclear power never fully price in. It is not an accident. It is not a safety failure. It is not a regulatory surprise. It is a market mechanism that was engineered for other purposes and has the power to make a fully functional nuclear plant worthless overnight. In deregulated electricity markets, most of the United States east of the Rocky Mountains, plus Texas, wholesale electricity prices are set by the cheapest available generator at any given moment. When natural gas prices are low, gas plants set the price. When solar and wind generation floods the grid with electricity that has effectively zero marginal cost, they drag the wholesale price down. This is called price suppression, and it is the mechanism that has forced the premature closure of more than a dozen nuclear plants in the United States over the past 15 years. Here's the specific math of why it's so lethal. A nuclear plant has overwhelmingly fixed costs: fuel, staffing, regulatory compliance, property taxes, decommissioning fund. These costs don't change whether electricity is worth $50 per megawatt hour or $20 per megawatt hour. But revenue is tied directly to the prevailing market price. When natural gas prices drop from $4 to $2 per million BTU, which happened during the shale gas revolution of the 2010s, gas plants' cost of generation falls, and they bid electricity into the market at lower prices, driving wholesale prices down across the entire grid. Nuclear plants can't reduce their costs to match. Their fixed cost structure means they need a minimum price to stay economically viable. And when the market falls below that floor, the plant hemorrhages cash every hour it operates. This is the fixed cost trap in its most extreme form. And unlike most other business categories, a nuclear plant cannot simply scale down or pause operations when prices are unfavorable. The plant must run, or it must shut down. There is no middle setting. Running at a loss while hoping market conditions improve is genuinely the rational strategy, because startup and shutdown costs are enormous, and the regulatory process for restarting a shut plant can take years. Keep this mechanism in mind. It's the trapdoor through which several plants have fallen. In 2013, Exelon Corporation owned the Kewaunee Power Station in Carlton, Wisconsin, a single-unit pressurized water reactor that had been generating electricity reliably since 1974. The plant was clean, safe, and mechanically sound. It had received a 20-year license renewal from the NRC in 2011, giving it authorization to operate through 2033. On paper, Kewaunee had 2 decades of generating life ahead of it. Exelon closed it on May 7, 2013. The reason? Natural gas prices had collapsed to the point where electricity from the plant could not be sold at prices high enough to cover operating costs. The plant operated in a deregulated wholesale market in the MISO region. When natural gas prices fell and wind generation expanded in the upper Midwest, wholesale electricity prices in MISO declined. Kewaunee's all-in operating cost ran approximately $50 per megawatt hour. Market prices were coming in below $35 per megawatt hour. Exelon estimated it was losing $40 million per year operating the plant. The company attempted to find a buyer. Industry analysts noted at the time that Dominion Power's Kewaunee had previously been valued in the hundreds of millions of dollars. No buyer emerged. The plant was sold to a decommissioning firm, Dominion Nuclear, and eventually to North Star Group, which is actively decommissioning the site. The decommissioning itself is projected to cost approximately $1 billion over the process timeline, with no revenue whatsoever to offset it. What had been a capital-intensive electricity-generating asset in 2012 had become a capital-intensive cleanup liability in 2014. Kewaunee was not the only one. Clinton Power Station, Quad Cities, 3 Mile Island Unit 1. All closed early, all in competitive wholesale markets. All for the same reason. Market prices fell below the fixed cost floor of operating a nuclear plant, and no mechanism existed to make the economics work. The cumulative capacity lost to these premature closures represents tens of billions of dollars of infrastructure. Infrastructure that the same generation of policymakers who oversaw its closure are now spending billions of dollars in federal tax credits to try to prevent from happening again. Let's run the numbers side by side. 2 years, same 1,000 megawatt plant, the same people, the same machinery, the same regulatory compliance program. In the good year, electricity prices average $55 per megawatt hour in the plant's wholesale market. The plant runs at a 92% capacity factor, generating 8.05 billion kilowatt hours. Wholesale revenue, approximately $443 million. Capacity market payments add $40 million. The Section 45U tax credit, at around $10 per megawatt hour, given market prices slightly above the phase-down threshold, adds another $80 million. Total gross revenue, $563 million. Total operating costs, fuel, operations, maintenance, capital, regulatory, property tax, decommissioning contributions, run $465 million. Net operating income before debt service, approximately $98 million. Margin, roughly 17%. A respectable return on a year's operations, though against a $10 billion or more capital base, it is a modest absolute return. In the bad year, natural gas prices fall. Wind and solar continue to expand on the regional grid. Wholesale electricity prices average $28 per megawatt hour. The plant still runs. You cannot turn it down without enormous operational and regulatory consequences. At the same 92% capacity factor, wholesale revenue collapses to approximately $226 million. Capacity payments hold at $40 million. The Section 45U credit, because the plant's gross receipts are now well below the phase-down threshold, provides the maximum $15 per megawatt hour, adding approximately $121 million. Total gross revenue, $387 million. Operating costs remain $465 million. Net operating result, a loss of approximately $78 million. The difference between these 2 years, same plant, same people, different electricity price, is approximately $176 million. That gap is determined almost entirely by a market variable the operator cannot influence, in a business where the largest costs are fixed and cannot be reduced. That is the economics of nuclear in a single number. So why do utilities, investors, and increasingly tech companies still seek nuclear power? The answers are not obvious, and they're worth understanding. For utilities operating in regulated rate-based markets, where a state public utility commission allows the operator to recover costs, plus a guaranteed return from ratepayers, nuclear operates on entirely different financial logic. The risk of price volatility largely shifts to customers. The operator earns a regulated return on the capital investment, typically 9 to 11% on equity, regardless of market conditions. This is why Georgia Power, operating as a regulated utility with rate-based recovery, was able to complete VODL despite $21 billion in overruns. The cost was extraordinary. The risk was borne by Georgia ratepayers, not Georgia Power's shareholders. For sophisticated financial buyers in competitive markets, the calculus shifted substantially with the Inflation Reduction Act. The combination of the Section 45U production credit for existing plants, worth up to $15 per megawatt hour through 2032, and the long-term power purchase agreements now available from data center operators seeking guaranteed clean electricity has improved the financial profile of existing nuclear plants considerably. A plant that was losing $40 million per year in 2012 without these mechanisms may be generating positive returns in 2025 with them in place. And there is a scarcity argument increasingly dominating the space. Clean, firm electricity, power that is carbon-free and available 24 hours a day regardless of weather, is a genuinely rare commodity. Solar doesn't generate at night. Wind doesn't blow all the time. Batteries can store energy, but at scale, and over multi-day calm periods, the physics and the cost make nuclear almost irreplaceable. As AI infrastructure demand grows and corporate net zero commitments deepen, the willingness to pay a premium for guaranteed, firm, clean electricity has made nuclear plants that were being abandoned 10 years ago suddenly look like strategic assets. The economics have not gotten simpler. The asset has gotten scarcer. And in electricity markets, like most markets, scarcity commands a premium. Let's come back to where we started. A nuclear power plant is a time machine with a bill. It commits capital today that won't return revenue for a decade. It sells electricity for 60 years while accruing cleanup obligations that won't be paid for a century. It employs hundreds of people managing obligations set in motion before any of them were born. And it does all of this against a backdrop of market prices it cannot influence, regulatory costs it cannot negotiate, and a decommissioning liability it cannot escape. The gap between the fantasy and the reality of this asset class is wider than almost anything else in energy finance. Not because the electricity isn't real, it is, and it's some of the cleanest, most reliable electricity on Earth. But because the cost structure is so heavily skewed toward fixed, unavoidable, decades-long obligations that a seemingly small shift in market prices, a few dollars per megawatt hour, can turn a functioning plant into an economic liability faster than a board of directors can convene. Here is the irony that most people miss. The plants that have survived longest and most profitably are not necessarily the ones that were built best. They're the ones that happen to be sited in regulated markets, where the fixed cost trap was hidden by a rate structure that guaranteed cost recovery. The plants that closed early were often equally well engineered. They just had the misfortune of operating in deregulated markets, where the price of electricity was allowed to fall below the floor their physics required. The atom doesn't care about market prices. Unfortunately, the mortgage does. A nuclear power plant doesn't just generate electricity for 60 years. It generates obligations, financial, regulatory, physical, environmental, that outlive the politicians who permitted it, the engineers who built it, and the executives who ran it. What you're actually buying, if you buy one, is 60 years of extraordinary capability and a century of extraordinary responsibility. That is not a business. That is an inheritance.